Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Joseph Biondo Jr., CEO of Biondo Investment Advisors, to discuss why equities have adjusted to their new reality. It's great to see you again, Joseph. Welcome back to Trade Talks.
Thanks for having me, Jill.
And we know volatility has reemerged. We're 2 days in front of the FOMC decision. Do you think the worst in terms of the volatility and chop that we've seen in the market is behind us?
We do. I mean, we're in that time of the year where between what's going on with the Fed and some elections coming up in November, that it may persist a little bit, but we do think that the worst of it's largely behind us.
Why do you think equity markets have adjusted to their new reality?
Well, there's been a really big shift in terms of the backdrop of equities from a year ago to today. So, obviously the Fed is a lot less accommodative than it was a year ago. Interest rates have moved higher. They've raised rates. There's a lot less liquidity in the system. Inflation has been more persistent than I think many investors thought, certainly a year ago. But even in the last few months and last weeks, inflation numbers were, didn't come down as much as people had hoped, and you saw some reaction in the equity markets from that. And growth has slowed. So the backdrop for equities has changed dramatically. So have prices. And so what we're saying is it's not like things are terrific, but when you get 30, 40, 50, 60% corrections like we've seen in a lot of growth stocks, we think the price is reflecting a new reality that's already baked into the cake, if you will.
From a technical perspective, are you seeing any signs of encouragement there?
Yeah, so one of the things that we pay a lot of attention to is money flow. And really what money flow is trying to do is measure the buying or selling pressure that exists inside of the equity markets. A year ago, there was a lot of selling pressure from a money flow perspective and was signaling some negativity to come. And so just about a year ago, we were getting signals that money flow was very weak, and it looked like there was sellers were more in control of the market. We've seen what the market's done over the last year since those signals started to show up. And lately we're seeing the exact opposite. So it looks to us like while price has not been great, institutional investors have been putting money away for buying stocks en masse for months, and we think that that's a precursor to a market advance that's ahead, that we're targeting towards the 200-day moving average. And if we can move through the 200-day moving average, it will signal more advances to come, and we may even be testing the highs that we saw at the end of 2021. We may see that sort of by the end of 2023.
Where are you finding compelling opportunities in the market?
So, I think secular growth stocks that have had these 30, 40, 50, 60% corrections, they're, solid businesses. Obviously, their valuations were stretched a year ago. They're a lot more compelling today. So there's a lot of opportunities that we're finding in technology, in healthcare. We like financials. So, it's pretty rampant where we're seeing opportunity if we look 1 to 3 years out from here and not 1 to 3 months.
All right, Joseph, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.